Whether we like it or not, currency valuations are a primary driver of both stock and commodity prices. We like to talk about supply gluts, demand destruction, growing cycles, the Chinese trade deal, but the reality is any change in currency valuation could render any of those factors almost inconsequential. We've seen this occur time and time again throughout the years, but it's a fact that we easily forget, particularly in today's environment when we're seeing historically low levels of volatility in the euro, the yen, and the US dollar. Currency markets are known for long and resilient trends, but in recent years we've been seeing nothing of the sort. In fact, aside from some Brexit volatility in the British pound, many of the major currencies have been trading mostly sideways for months, and in some cases even years. The US dollar index itself, which depicts the value of the greenback relative to a basket of global currencies, has been hovering in the high 90s since 2015, ignoring a few temporary strays in pricing. We certainly didn't expect the currency markets to be a non-factor in 2019 as they have been, but we've been following the markets long enough to know that low volatility is eventually and always followed by the opposite. When the currency market volatility shows up again, and it will inevitably, it will change the commodity market landscape. Our best guess is that volatility will come in the form of a lower US dollar and a higher euro currency. And yes, we're aware of interest rate differentials, but we think a lot of that's already priced in. Based on current market correlations, a weaker dollar or a stronger euro would be bullish for most commodities and bearish, or at least a headwind for stocks. Not surprisingly, we're seeing an all-time low volatility reading in the currency market simultaneously to similar low volatility levels in crude oil. WTI crude oil, which is traded on the NYMEX, the New York Mercantile Exchange, it's a division of the CME Group, has been trading comfortably between $50 and $60 per barrel. Ironically, we talked to a lot of traders who've been conditioned to believe that a move between 50 and 60, a $10 move, is a high volatility event. But if you take a step back and look at the weekly chart, we can see that a $10 move in crude oil is minuscule compared to what we've seen in the past. In fact, crude oil rarely trades sideways with declining volatility, as it has been. Further, periods of calm have generally been followed by large price moves, some to the tune of $30 and $40 per barrel. Although a breakout may not happen immediately, it eventually will happen. Our best guess is the breakout move in crude oil will be to the upside. Look for a break and hold above 61.50 to 62 to lead the way higher. If oil weakens first, look for support around the 53 area to hold. Traders and even buy and hold investors have really lost interest in crude oil. However, if the currency markets come back to life, it's going to put crude back on the map.